Welcome to Cambridge House Live. I'm Vanessa Collette here at the 11th Annual Silver Summit in Spokane, Washington. I'm joined by John Kaiser, founder of Kaiser Research Online. Welcome, John. It's great to have you back with us.
Vanessa, it's great to be here.
John, you've said that the supercycle is still intact, but many investors might be forgiven for thinking otherwise. Can you explain that a bit?
Well, the supercycle in terms of long-term structural growth coming from places like China, India and all that is still intact in the sense that these countries have not finished their long-term growth projections. However, we have a slowdown in the demand for metals, and we've got a supply response that's taken care of some of the imbalance that developed. So we have weaker metal prices and a supercycle in the sense that metal prices keep ramping upwards forever. That is not happening right now. But in 3-4 years, the very slowdown right now that is causing projects to be mothballed, suspended, and so on, is going to bring the imbalance back, provided global economic growth continues to be positive and doesn't spiral into some sort of recession, depression.
And is that because of all the production that's being cut right now and projects that are being suspended?
Well, part of the growth spurt last decade was China spending an enormous amount of money on infrastructure and production capacity, which is very raw material intensive. And they, to some degree, have overbuilt in this area, and they're trying to shift their economy away from being so export dependent to being more domestic consumption dependent, and that does not consume the same amount of iron and copper as the infrastructure build-out did.
And John, you've pointed out that the majors have already bought a lot of undeveloped deposits in the past few years, so they might not be buying. Who could be buying the juniors?
Unfortunately, what we are now seeing are private equity predators, or some of the companies that are mid-tier companies which are not trying to digest some $5 billion capex blowout from acquiring something else for $1 billion during the last decade. And because there is no competition, they're able to scoop up assets at relatively modest premiums. So for people who want to buy these companies with advanced projects and just sit on it for several years and get a 300-400% out of it, they are ending up being scooped at modest upsides of 25-50% as exhausted shareholders just tender and say, let me out of here.
Now, have you seen much evidence of China buying lately?
China has not made any significant acquisitions in the resource sector. We know they're prowling around watching everything, but they have not yet made a move.
Now, what's your take overall on the junior sector? Are you optimistic at all?
I think we will have a capitulation washout in the final quarter of this year. There is still some redemption runs we can worry about as the last of the resource sectors lose their investors and are forced to unload the more advanced companies. For the sort of earlier stage companies, we will see retail just out of sight, out of mind, dumping by the end of the year. But I'm seeing a bifurcation already in the market where there's 800 companies that don't have enough money to survive. I think they're history. There's another 800 which do have enough money to survive, and we're starting to see selective, very modest but visible uptrends develop, and it's starting with the bigger companies, and I expect that we'll actually see that by the end of this year, the kinds of sort of quality bottom fish type companies will be higher than they are right now.
Are there any signs of money starting to come back into the metals markets?
You mean the resource equities? Yeah, well, this past week we have seen, like for example, some of these silver producers at this conference where we're at right now, they have shown pretty interesting upticks. So that's the capital looking for the turnaround. And an interesting comment somebody made who went to the Denver Gold Show was the metals funds guys and gals were completely absent. But for the first time, there was an unusual presence of generalist fund managers. So the people who manage these big diversified funds have noticed that the resource sector is at a secular low, and they are coming in here with a longer term outlook, several years outlook, and they're saying we can find some value here. We don't need to make money overnight. Right. And of course, this kind of stuff does, as more of it happens, it starts to snowball, and we see stocks actually then turn around, and we could see a bit of a panic buying rush on the companies in the new year, the better quality ones, but I don't see metal prices ramping higher in any meaningful way to pull in the capital in a broad-based manner.
Well, speaking of the metals prices, what kind of prices do you think we're going to need to see in order for things to really get rolling again?
In markets like copper, copper is an example of where there were a lot of big buyouts of large deposits by the majors, and a lot of these projects have been put on hold, but enough are coming on stream that there will be plenty of copper to take care of demand. So we will see copper in deficit for the next few years. Ironically, we may actually see higher spot prices, not because of demand, but because of a smelter bottleneck that's emerging. So the producers aren't going to be getting the higher copper price. It's going to be the smelters making that higher copper price. The concentrate will be piled up in the warehouse, waiting for its turn in the full capacity smelters.
Right. Now, John, what's your outlook for silver?
I think silver has bottomed at these levels. An interesting development is that end user consumption, instead of suffering demand destruction as a result of a silver price that's 5-6 times higher than where it was 6-7 years ago, they've actually increased consumption. So that suggests that in the real world of using silver for stuff, they've adapted to the new price reality, which means that as additional new supply comes on stream as byproduct from all these other big copper, gold, and zinc mines, the end user will be able to absorb that. The wild card with silver is investment demand. And we had, of course, it tracked gold's retreat this year. But even in the last month or two, although gold is still seeing destruction of investment demand, silver investment demand has come back. So I'm quite encouraged. I would not be surprised to see silver back at $30, $32 within the next 12 months.
Wow. Do you think that the miners should be happy with $20 silver?
Well, miners are never happy with the current price unless tomorrow it was higher than what they end up with. Everybody wants a higher price. But the interesting thing about the companies, say, at this conference is they built their mines with a lower base case silver price in mind, considerably lower than what's been swallowed up through the cost escalation that we've seen. So they have profitable operations, and some of them are trading at 5-7 to 1 cash flow multiples. Some of the stronger ones, like First Majestic, are already back at 9-10 for 1, but that's because they actually have a growth trajectory, and they're actually a sector to take a close look at right now if you're looking for producer type companies, especially at the mid-tier level, which is what there are no major silver dominant producers.
And is that what you've started to do with your money now? Have you started to plug your money back into the markets?
Yes, a lot of stocks have bottomed where they have a good story. The kind of story that I'm interested in the moment is not ones which require a higher metal price. It's one where there's some sort of fundamentals at play which can evolve over time and reward us 3, 5, maybe 10 times because they actually deliver on the fundamentals, and not because gold is ramped back to $1,700 or silver to $50.
What do you think could send the venture down again? It's had a little bit of a rebound since June.
Well, it had a rebound in August and partly into September as gold bounced off that 1191 low. But when gold failed to make it through 1400 and got sent back to 1300, that rally failed. And I think now we're heading into the year-end washout. But again, as I mentioned earlier, there are signs of selective buying coming into this market right at a time where, you know, we just had this government shutdown and debt ceiling debacle, which got merely kicked down the road 4 months. So this whole risk of tanking the economy is going to be with us again. So everything should be in a really foul mood and just getting rid of this stuff. But instead, we're seeing buying come into more at the sort of producer level, but even some of the advanced companies where they have, you know, the existing ounces and the cost structure figured out. So we're seeing that come in earlier than I thought it would.
Moving over to India and China, you've expressed some concern over the economies there. What's your take there?
Well, China has engineered a slowdown into the 7-8% range, which is probably more sustainable. India has had a rocky year because they've seen a capital flight when the taper was announced or at least threatened. And they have all kinds of awful structural problems. We're seeing big companies, even Indian companies, just pull the plug on big giant operations because there is such bureaucratic hassles in getting anything done that they're just throwing in the towel. So I think India is basically harming itself because it cannot introduce the reforms that streamline getting stuff done.
Absolutely. Well, John, it was a pleasure having you with us again as always, and we look forward to having you back again soon.
Thank you, Vanessa.
Thank you.